During Chapter 6, we will identify the management issues associated with merchandising operations, define and distinguish the terms of sale for merchandising transactions, prepare income statements and record merchandising transactions under both the periodic inventory system and the perpetual inventory system. We will learn about internal controls and the 5 components of internal control and explain 7 different examples for internal control activities. Then we will describe some limitations associated with internal controls. And lastly, we will apply internal control activities to common merchandising transactions. Let's start with Objective 1, where we will identify the management issues related to merchandising businesses. Let's begin by discussing or distinguishing between merchandising businesses and service businesses. Merchandising businesses differ from service businesses in that they have goods on hand for sale to customers and engage in a series of transactions called the operating cycle. Service businesses provide a service to a customer. The items that they sell are intangible. You can't touch or feel the service that they provide. Whereas with a merchandising business, they earn money by buying and selling products or merchandise. These products or merchandise are tangible items. They are inventory of goods to be sold. The issues associated with a merchandising business are that they have to manage the operating cycle or the cash flow of the business. They have to buy goods using cash or credit, sell those goods for either cash or on account, collect the cash from their credit sales, and then pay for the goods or services that are purchased from other parties. Those 4 items are really considered to be the operating cycle. Some of these issues that are associated with a merchandising business are also associated with a manufacturing business. But in addition, with a manufacturing business, they have to take into consideration the time that it actually takes to make the products that they're manufacturing. The issues that a merchandising business must address can be broken down into 4 primary issues. The first one is cash flow management or liquidity. Merchandising business must manage its merchandise inventory, that is, the goods on hand for sale to customers. It must plan the receipts and payments of cash to its vendors and ensure that the operating cycle, which is the average days of inventory on hand plus the average days it takes to collect any accounts receivable from sales, equals the operating cycle or the time of the operating cycle. Since purchases of merchandise are usually made on credit, the merchandiser must plan for the cash flows from within the company or from borrowing to finance its inventory until it sells and collects the cash from its sales. Operators of merchandising businesses must carefully manage the cash flows or liquidity. If a company can't pay its bills when they're due, it may actually be forced out of business. So this operating cycle has to do with the amount of time it takes between buying its inventory, selling its inventory, collecting on the accounts for any accounts that are collecting on any accounts for sales transactions that are sold on account, and then paying its vendors for the purchases that they made at the beginning of the operating cycle. This cycle can take as long as 120 days or longer for larger types of merchandise. When you think about, and we've discussed this in the past, when you think about a plane if a business is a manufacturer of a plane and they're building that aircraft, it obviously takes a long period of time to build that aircraft. So the longer it takes to actually produce the item, the longer their operating cycle will actually be. The second issue associated with a merchandising business has to do with profitability management. A company must sell its merchandise at a price that exceeds its cost by a sufficient enough gross margin to cover operating expenses. In order to do that, it must set appropriate prices to ensure profitability. It must purchase merchandise at favorable prices and terms and maintain operating expenses at acceptable levels. In other words, a business must set high enough prices to achieve a satisfactory gross margin. The gross margin must cover operating expenses and provide sufficient net income or profitability for the business owners to want to stay invested in the business. An effective tool to help management control its expenses and manage its business is an operating budget. This is basically a system where the business will establish what they project to be their income levels and their expense levels, and then compare over time the actual results to those that were projected. It shows how their expenses are compared from a budget to actual basis. It also helps management focus on specific areas of profitability that might require attention. The third issue that management must deal with in a merchandising business is its choice of inventory systems. There are two primary inventory systems. The first is the perpetual. Perpetual inventory is a continuously updating system. Purchases, sales, and cost of goods sold are continually updated, and it's through the use of computers that enable most businesses to do a perpetual inventory system. Under perpetual, continuous records are kept of the quantity and usually the cost of individual items as they are bought and sold. It is more effective for providing information about quantities and ensuring optimal customer service. The cost of each item is maintained in an account called the merchandise inventory account when each item is purchased. As the individual merchandise is sold, its cost is transferred from the merchandise inventory account to the cost of goods sold account automatically through the computer system. The second type of inventory system is called a periodic inventory system. Under a periodic inventory system, physical inventory is counted usually at the end of each accounting period. During the accounting period, there is no detailed record of the actual inventory balances that are maintained during that accounting period. Inventory is technically only accurate on the date of the balance sheet immediately following a physical inventory count. A periodic inventory system is considered to be less costly than a perpetual inventory system, but it also provides less information. It is often used, or in the past it was used, for high-volume, low-cost merchandise. In most cases today, most businesses maintain a perpetual inventory system simply because through the use of computers, this can be done. However, in businesses that are considered to be high volume and low cost merchandise, for instance, something along the lines of a dollar store, that type of business might just continue to maintain a periodic system because, again, the volume and dollar amount of the merchandise, the volume is high and the dollar value of each individual piece of merchandise is low. So, what are the 4 issues that must be faced by managers of a merchandising business? Let's look at Objective 2, where we will define and distinguish the terms of sale for merchandising transactions. When businesses sell inventory on account, both parties must understand the expectations for payment and delivery of that merchandise, as well as any warranties relating to the sales of those items. When determining the prices for products, businesses often quote prices to each other using 2 common terms of sale. The first is called a trade discount. Trade discounts are when manufacturers and wholesalers sell to each other or the retailers, provide a price list or catalog price, and then quote prices as a percentage of that list or catalog price. Reductions from the list price or percentage discount from the list price is what's considered to be the trade discount. Trade discounts are not recorded in the business's accounts. Trade discounts will vary depending upon the relationship between the customers and the quantities to be purchased. A typical example of a trade discount would be a situation where if you have the list price of an item, say it's $1,000, and there's a trade discount that has been agreed to. If the trade discount is 40%, then the actual dollar amount of the discount would be $400. The seller would record a sale of $600, and the buyer would record a purchase of $600. There would be no reflection of the discount in the journal entries. Next, let's look at sales discounts. Sales discounts are terms that are typically offered as a discount for early payment.